Hello and welcome back to Lipper's Fund Flows Insight Report. I'm Jeff Turnahoy. For the week ended December 9th, 2015, we saw an interesting week of flows data come through our system. Let's take a look at our macro groups and see what transpired. Look at the top here. We've got $13.5 billion out of equity funds. We'll talk about that shortly. Taxable bond funds had $7.2 billion in outflows. Municipal debt funds had $620 million in inflows, and money market funds took in $13.5 billion. Well, reading off the top, it certainly looked like a lot of investors moved money from equities to cash, and while that may very well could have happened, it seems unlikely given that this is distribution season for many mutual funds, and equity funds in particular are going to have sometimes weird-looking data coming through in the middle of December, towards the end as well. So it makes for some strange data. Let's take a look at the data more closely, shall we, in this week's view. So while the performance this week was rather poor, down about 1.36%, it was the worst performance since September, and so that might get you to think that investors were pulling out of their equity funds left and right. But we also saw, as I said before, some distributions come through, which due to their timing have made a bit of an awkward circumstance, where on the one hand we see distributions declared and paid on a Wednesday, but the reinvested amounts aren't known by Lipper until Thursday. So case in point, Columbia Acorn. It was a fund with a $30 NAV, give or take, that declared and paid a $10 distribution on Wednesday, again, give or take a few cents. But Lipper doesn't have the final asset data reflecting reinvested distributions until Thursday. So consequently, that fund appeared to have 30% of its assets walk out the door for the week, while in fact that's highly unlikely. We'll see most of that come back and wash out next week. So for now, while it does look like $13.5 billion in outflows for equity funds, the true number, which we'll see next week, is likely to be far, far smaller. In fact, we can take a cue from the equity ETF side to see what investors may have been thinking this week. If we look at ETFs right here, we'll see that they had inflows of about $4.9 billion this week. They've had 9 consecutive weeks of inflows, so there's plenty of opportunity out there for equity investors. And the gains this week were very broad. We didn't see too many funds taking in the lion's share of the money. In fact, there were some softer spots in the market. Of course, we saw technology, Europe, large caps with inflows though. So those weaker parts of the market, those the ones that were betting against equity markets, such as short ETFs. Also some funds or some strategies, I should say, which may have peaked a little earlier, such as healthcare, and certainly energy has been nobody's favorite for much of this year. So while there were a few soft spots in the equity market for flows, broadly speaking, we saw pretty good inflows this week. SPY, of course, led the way towards outflows, $1.5 billion out. That may have been sold in anticipation of finding something better to do with their money. So overall, a pretty good week for inflows to equity ETFs. Let's turn our attention now to that very large outflow number for taxable mutual funds, I should say. This would appear to be the worst week of outflows since August of 2014. This has a better chance of being true than equity funds. Initially, when I saw these numbers last night, I thought that they were too following equity funds with distributions. However, most taxable bond funds pay distributions monthly. I didn't take that into consideration. So we're likely to see some pretty steady outflows, or some heavy outflows, I should add, at the end of the year for taxable mutual funds as investors decide maybe now's a good time to reallocate towards something else. So overall, a soft week for taxable bond funds. So we might expect to see further outflows next week, especially in the high yield market, where news on Thursday that Third Avenue Credit Focus Fund was blowing up sent the market into a tizzy. Now, we did get assets reported for Third Avenue Credit Focus, and for this week, they saw outflows of about $111 million. So it did have an impact on outflows, but it was not as significant as maybe some people thought. The next group to take a look at is bond ETFs. They also saw outflows this week, about $700 million. Not a terrible week for them. J&K led the way with $723 million. Again, a lot of high yield related concerns out there, but J&K has seen far worse weeks earlier. We saw Treasury funds also suffer outflows, about $490 million pulled from them. Surprisingly, TIPS funds were bucking that Treasury trend. They saw inflows of $196 million into TIP. Well, the next group to take a look at did not find too much to worry about this week. Municipal Debt mutual funds had inflows of $620 million, one of their best weeks in quite a while, although the week was relatively flat as far as performance goes. We saw high-yield muni debt take in about $190 million, shrugging off concerns about the broader corporate high-yield market, and intermediate muni took in a respectable $327 million. Again, what was surprising this week is that investors in the muni market were shrugging off the volatility of treasuries and sticking with their munis instead. The final group to look at is money market funds. Again, they took in $13.5 billion, a pretty good week for that. This was split between retail, which withdrew about $1.2 billion from their accounts, and institutions, which added $14.7. Or we could slice this differently. Tax-exempt money market funds had outflows of about $377 million. Prime money market funds took in $9.1 billion, and government and treasury-related money market funds took in $4.6 billion. Well, that was an interesting week, and we look forward to seeing you next week. Join us online at any time at lipperusfundflows.com, and we'll speak to you later. Thanks for watching.